Morning, guys. It's Tuesday, June 3rd, 5:25 a.m. Central Time. Grain markets are mixed this morning. July corn futures down 1 at 437 and a quarter. July soybeans up 3 cents at 1036 and a half. July Chicago wheat down 5 and a quarter at 533 and three quarters. July Kansas City wheat down 8 and a quarter at 531 and a half. July spring wheat is down 8 cents at 619 and a quarter. We've got some rain on the radar this morning. Why don't we start there?
So the radar is active over the western U.S. Corn Belt here this morning. Storm systems move through large parts of Nebraska and western Iowa, in addition to parts of South Dakota, Minnesota, Colorado, and Kansas. Based on GFS data, our friends at CropProphet estimate that U.S. corn areas will see 1.5 inches of rain on average over the next 7 days. During the 8 to 14 day period, it's estimated that U.S. corn areas will see nearly an inch of rain on average. Temperatures are slated to run below normal in the west and above normal in the east over the next week. The 8 to 14 day forecast offers normal to above normal temperatures for most of the U.S. Corn Belt.
Again, we've got a non-bullish weather situation this morning. You've got rain over the western Corn Belt. And remember this, there had been, as there is every year, but there were a lot of drought calls this year. A lot of people, a lot of weather forecasters talking summer 2025 drought. And maybe that could still happen. It's pretty damn early. But as it stands this morning on June 3rd, you've got rain over a lot of the driest portions of the western Corn Belt. And I'm not sure exactly what fell and what didn't. There could be a whole bunch of this green stuff where no rain actually fell, but it looks pretty decent to me. If you guys have rain totals from overnight and you're in Nebraska or western Iowa, drop them in the YouTube comments. So this is just seen as being a benign to non-friendly forecast because there's too much rain. You got 1.5 inches in total over the Corn Belt on average over the next 7 days. And just the next 5. I mean, this is just plain old GFS data. It's just too much rain in too many places. It's just not going to get the market excited this time of year. 8 to 14 day, it does dry out just a little bit. You're talking 0.9 inches of rain in total on average over U.S. corn areas. And that's a little bit less than normal, I guess. But when you look at the percentages of normal, which is maybe a different way to look at it, I'm just trying to give you guys a few different perspectives here. Over the next 7 days, you're talking 170% of normal rainfall over U.S. corn areas. But then that number drops down to 83% of normal during the 8 to 14 day period. In any case, I don't see this as being a friendly input in any way, shape, or form. You've got some, I'm not going to call it heat, but more normal-ish type temperatures coming in to most of the Corn Belt during the 8 to 14 day period, maybe a couple degrees above normal, but nothing to write home about. So it's a benign, non-bullish, non-friendly weather situation. And that has been your big driver of prices, I believe, this week. We had kind of a nasty looking sell-off yesterday. Why don't we go to that?
So soybean futures dropped to their lowest level in nearly 2 months yesterday. The July 25 contract fell roughly 8 cents, settling near 1034 per bushel. Corn futures also moved lower. The July 25 contract lost nearly 6 cents to settle near 438 per bushel. The declines were attributed to favorable growing conditions. Soybeans faced additional downward pressure from an improved outlook for Brazil's crop, along with increased trade tensions with China. In contrast, Chicago wheat futures advanced yesterday, with the July 25 contract gaining 5 cents to settle at 539 per bushel, supported by a weakening U.S. dollar and a Ukrainian drone strike in Russia.
I understand that some of you guys in the eastern or southeastern portion of the Corn Belt, if you're in Ohio or Kentucky, you're going to look at our comment about favorable growing conditions and say, we're a mess out here. We'll get to that in a second. The soybean market doesn't look good. You broke out below this 1036 area in the July soybean contract. You'd like to see a recovery today, but from a technical standpoint, that was kind of an area of support. Maybe you go down and test that uptrend line, which I think is about 995 today. July corn futures look very bad. Lowest trade since October in that contract. It's really fallen off a cliff here the last few sessions. Again, I think most of this has to do with weather. I mean, there's a lot of headlines out there. There's a lot of tariff stuff out there. I mean, but weather, bar none, is the biggest driver of prices this time of year. The wheat market actually looks the best out of the three just over the last couple of weeks or so. You might argue that there's kind of an inverse head and shoulders pattern here. Brian Split will be on to talk to our premium subscribers about that tomorrow. So price action overall, not very good.
U.S. corn crop conditions improved slightly last week. The crop was rated 69% good to excellent nationally as of Sunday, compared to 68% the prior week and 73% on average. The rating matched analysts' expectations. States with a good to excellent rating of 70% or better include Indiana, Iowa, Kentucky, Minnesota, Missouri, North Carolina, Pennsylvania, and Wisconsin. The crop was 93% planted nationally through Sunday, up from 87% the previous week. In its initial rating, the U.S. soybean crop was rated 67% good to excellent nationally, slightly below the 5-year average of 69% and analysts' expectations of 68%. States with a good to excellent rating of 70% or better include Iowa, Kansas, Kentucky, Louisiana, Minnesota, Mississippi, North Carolina, and Wisconsin. The crop was 84% planted nationally through Sunday, up from 76% the prior week.
Nationally, when you look at the numbers, there appears to be no real problem. You look at the ratings, and yeah, corn's a little bit below average, but given the forecast and the rains that are on the radar this morning, the trade is probably of the opinion that these ratings improve. Let's talk about the Eastern Corn Belt. The Ohio corn crop is only 72% planted versus 87 on average. Kentucky is 80% planted versus 89 on average. Indiana, 86 versus 90 on average. That slow planting and just the generally wet situation out there has also contributed to poor crop ratings. The corn crop I'm trying to flip through my sheet here. Corn crop in Ohio was rated only 46% good to excellent versus 71 on average. Michigan also very bad at only 53% good to excellent versus 62 on average. Illinois corn is behind average, 63% good to excellent versus 67 on average. Wisconsin is also below normal, 70% versus 77 on average. The Dakotas are also in the 50s in the good to excellent category. They would be in the upper 60s on average. So there are absolutely some problems. It just appears that the market is disinterested in those problems and is more interested in current and forthcoming rain. What ends up happening in the Eastern Corn Belt in places like Ohio in particular, do you get acres that switch from corn to soybeans? Yeah, it's very possible. My friend Lewis Stearns, who's an agronomist in Ohio, is going to join us in Thursday's premium video to discuss some of the agronomic issues in the Eastern Corn Belt. And just to be clear, the agronomic issues are not the same thing as the market this time of year. As I mentioned yesterday, the market tends to take a very, very extremely simplistic view of weather this time of year. Either it's raining or it's not, and that's how the market acts. If you run into problems like it's too wet or, some of this stuff that can affect yields later in the year, the market will sort that out later in the year, but it just doesn't seem to matter right now. Let's go to winter wheat.
So, U.S. winter wheat ratings increased last week. As of Sunday, the crop was rated 52% good to excellent nationally versus 50% last week and 43% on average. The rating was the best for the week since 2019 and also surpassed analyst expectations of 50%. U.S. spring wheat conditions showed a notable improvement, with the good to excellent rating rising to 50% nationwide compared to 45% the prior week. The rating exceeded analysts' expectations of 47%, but remained well below the 5-year average of 68%. Additionally, the rating is the lowest for the week since 2021, and prior to that, the lowest since 1988. The crop was 95% planted nationally through Sunday, up from 87% the prior week.
Okay, so winter wheat ratings improved a couple points. The trade thought they were going to be unchanged, and that's probably part of the reason that we're down this morning. There was some Russia-Ukraine conflict over the weekend, and we rallied yesterday, kind of gave some of it back, and now we're lower to sharply lower this morning. Spring wheat, as I kind of assumed would happen, you're seeing some big swings in the ratings. Like the North Dakota spring wheat rating improved 11% in the good to excellent category in 1 week. Minnesota went up 7% in 1 week for no apparent reason. It's just they don't have a good feel for it, and they're going to try to dial in those ratings. If you guys have thoughts on the spring wheat crop in those areas, let me know, because the ratings, I'm not sure if the rating at 50% good excellent is telling us the whole story or not.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
We did the second part of our transition planning mailbag yesterday, and these are longer videos. I think they're 40 or 45 minutes long each, with my friends Chris Barron and Shay Folk from AgView Solutions. They spend a ton of their time helping farmers with transition planning. And in these videos, we took questions from our premium subscribers about transition planning. Some of it was super specific. Some of it was more kind of big picture type stuff. But if you're a farmer, you're probably dealing with this in some way, shape, or form. There's a whole series of videos, and they were all included in this morning's email. So if you sign up for the premium deal this morning, I'll forward you a copy of that email. You'll see all 6 or 7 videos. I know this is a touchy subject for a lot of people, and these videos help to open the dialogue. Pete Meyer's doing Sunday weather updates for us every week. And let me be clear about one thing. If you're going to have somebody explain the weather to you on Sunday night and you're interested in it as it relates to the markets, you don't want a weather person doing it. You want a market person doing it. You want a market person explaining the weather to you and then explaining how it relates to the markets. And that's what Pete's going to be doing for us every Sunday night from now through the second or third week of July during like primetime U.S. weather market season. These are almost always our most viewed videos. They go out an hour before the grain markets open on Sunday afternoon. They're usually pretty quick, less than 10 minutes. And they'll give you kind of the lay of the land and a primer to start the week. In today's premium video, I'm going to be back to some market type stuff. Corn futures have a seasonal tendency, new crop corn, to peak sometime in mid-June, and that looks very unlikely this year. So in today's premium video, I'm going to discuss past years in which the peak came later and talk about some possible analogs for what's going on this year. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation, nobody will try to sell you anything else. Just a ton of info direct from us every single business day. We don't want to do your brokerage. We don't want to sell you crop insurance. We're not going to give anybody your info. I'm never going to call you ever. We just want to send you info for $50 a month. That's it. So give that deal a shot this morning, guys.
Morgan Stanley, JP Morgan, and Goldman Sachs expect the US dollar to further decline. According to the Wall Street banks, anticipated Federal Reserve rate cuts, slowing US economic growth, and President Trump's policies will serve as key drivers of the decline. Morgan Stanley projects the US dollar index will drop about 9% to 91 by mid-2026, reaching levels last seen during the pandemic. The banks are turning bullish on the euro, yen, Swiss franc, and Australian dollar, which they expect to benefit from the greenback slide. Dollar short positions remain close to their highest levels since 2023 as foreign investors increase hedging and reassess their exposure to U.S. assets. On Monday, the Bloomberg Dollar Spot Index fell 0.6%, approaching its weakest level since 2023.
So when they all agree, they must be right. It's like when they all called for a recession a couple of years ago and they were all wrong. But in any case, the dollar chart looks terrible. It doesn't look good. I mean, you posted some fresh with 2 or 3 year lows just in April when the tariff stuff first kind of was announced and Trump did the whole reciprocal thing. And then we rallied and now we're kind of back down. And if you take out that 98.04 in this on this weekly continuation chart, it's not going to look good. I don't know what Trump's going to say next. We don't know what his policies are going to be necessarily. We flip-flop all the time with tariffs and tariff relief and all that sort of stuff, and the headlines are back and forth. I'll tell you this, though. If you don't get a weather situation that results in a grain rally this year, maybe your best chance for a grain rally is that a sharply weaker dollar is the deal. And there's a commodity bid based off of that. And to be perfectly honest, that's probably better case scenario for you guys. Wouldn't you rather have a good crop and sell into higher prices because of a cheap dollar than have a short crop? I mean, you probably would. So I don't know. It's maybe one thing to be optimistic about.
U.S. crude oil futures rallied on Monday. WTI crude gained roughly 3% to close at $62.52 per barrel. The gains came as OPEC Plus stuck to a steady pace of production increases, easing investor worries about a bigger supply boost. Futures also found support from a continued decline in the U.S. rig count, which fell each week in May to its lowest level since 2021. Despite Monday's rally, WTI prices are down roughly 13% this year, weighed down by rising global supply and demand concerns stemming from President Trump's tariffs. According to experts, if prices don't rise, U.S. oil production will likely be cut, potentially tightening supply and pushing prices higher in the long term.
Crude has been in a loose bear market trend for the better part of 2 years now. And we made some lows for that entire move just a month or two ago in early April, kind of the same time the dollar bottomed out when the tariff stuff was announced. And we've recovered a little bit, but it's still a downtrend. Some people think this is a red flag for the economy. Some people think this is just not a good thing for commodity prices. Maybe it relates back to grains. Crude's always been kind of the bus driver of the commodity complex. And it looks a little better, but big picture still doesn't look great.
U.S. corn shipments exceeded pre-report expectations last week. USDA reported that 62 million bushels of corn were inspected for export during the week ending May 29th. The print was up 11% compared to both the previous week and the same week last year. Soybean shipments were reported at 10 million bushels. The print was up 34% from the prior week, but down 26% compared to the same week last year. Wheat shipments were near the upper end of expectations at 20 million bushels. The print was down 1.8% from the previous week, but up 29% versus the same week last year.
Corn shipments very strong again. I know the sales reported last week weren't fantastic, but the shipments are very good. You wouldn't know it by looking at the market, though. I mean, nearby corn futures, as I mentioned, multi-month lows. You get corn spreads. July D's is almost like flat, basically. You got a very, very small inverse this morning. So I think people continue to believe that, one, the U.S. crop's going to be damn big this year, and two, maybe USDA is overstating feed demand. Maybe they're wrong about last year's crop. I don't know. What did cattle do yesterday?
Cattle futures were up big. Live cattle saw gains ranging from 107 up to 180. Feeders were up anywhere from 287 to 355. Box beef prices were mixed yesterday. Choice was up 34 cents at 366 even, and Select was up $1.46 at 358.11.
The Dow Jones is down 170 this morning. The S&P is down 23. Treasuries are up a little bit. U.S. dollar is now higher, had been a little bit lower at one point overnight. Crude oil is about flat. Gold is down $12 in the August COMEX contract at 33.85. Have a great day, guys. We'll be back on Wednesday.